Good afternoon, this is Dale Allentenny with the Gus and Cho team in Loan Cabin. I'm here today to talk to you real estate investors who I've often talked to previously, do a little compare and contrast between maybe what can be offered to you as a conventional buyer versus using some of the other products that are designated for business purposes, which purchasing an investment property for the purpose of cash flow would be designated as that. So if you're an individual maybe with a high FICO score, and you're debating whether to go conventional or use one of these non-QM products that I've often spoken about, let's do a little comparing. So we know the maximum loan amount on conventional in many areas is $510,000. Now, if you are a full doc borrower, in other words, you can verify your income, W-2s, tax returns, maybe you're an existing real estate investor and you have Schedule E income, versus maybe a situation where you're a non-QM borrower and maybe you can't verify your taxes and insurance, or you don't show enough on there. Here are some of the pluses and the minuses. Obviously with conventional, you're going to get the lowest rate, but you're going to be restricted on your loan amount, your reserve requirements are going to be higher, and you got to make sure that you qualify on full income. Whereas on the business purpose loan, on the non-QM side, you can go larger loan amounts. You can definitely go over 510 depending on the scenario. There's no restriction if the property is a 3 or 4 unit property. You don't provide tax returns. The income is assessed basically on what they call a debt service coverage ratio. So if you have a $1,000 mortgage payment, the average market rents on typically have to be at least $1,000. Now these programs are getting more aggressive because they're performing so well. Now if you have a $1,000 mortgage payment, you only need an $850 average market rent, so you can be a little bit below that. But typically I would use 1-to-1 as a rule of thumb, up to 4 units, so your LTV is not cut back if you go up to 4 units. It is in other cases. You do need reserves of at least 3 months, but they're scaling back on that as well. So if you have 20% down, you're not a first-time home buyer, and your loan amount is less than $1 million, you technically don't have a reserve requirement. If you're somebody with a recent credit event, 2 years ago you had a foreclosure, 2 years ago you had a short sale, deed in lieu, Chapter 7, and you've recovered fully and you have a decent FICO score, maybe 680 or up, you can do 25% down, so a little bit more than 25% down, and get yourself into an investment property. So that's a great opportunity that doesn't exist in the conventional world. The rates are still relatively competitive, and more importantly, are you cash flowing well? And if you are, it's something you should definitely consider. Call me, Dale at Loan Cabin, 630-479-2719, or email me at dale@loancabin.com. Please share, like to Facebook, Instagram, or Twitter, and as always, I appreciate you watching my videos. Thank you. Good?